Hello and welcome. Today, we're going to talk about a fundamental investment strategy that can significantly benefit beginner investors: dollar cost averaging. This approach is about consistency, discipline, and reducing risk in your investment journey. Dollar cost averaging, often abbreviated as DCA, is a simple yet powerful investment technique. It involves investing a fixed amount of money at regular intervals, regardless of the market's ups and downs. This means you commit to investing the same sum every week, month, or quarter. The core idea is to avoid the pitfalls of trying to time the market. Instead of attempting to buy low and sell high, which is incredibly difficult even for seasoned professionals, DCA encourages a steady, systematic approach. It removes emotion from your investment decisions. Many new investors fall into the trap of market timing. They try to predict when the market will go up or down, hoping to buy at the absolute bottom and sell at the absolute peak. This strategy is fraught with risk and often leads to poor outcomes. Market timing is notoriously difficult. Even experts struggle to consistently predict market movements. Reacting to daily news or emotional impulses can lead to buying high out of excitement or selling low out of fear. This can severely damage your long-term returns. With dollar cost averaging, you commit to investing a set amount, say $100, every month. When the market prices are high, your fixed investment buys fewer shares. When prices are low, that same $100 buys more shares. Over time, this strategy averages out your purchase price. You end up buying more shares when prices are low and fewer when prices are high. This natural balancing act helps to smooth out the volatility of the market. DCA offers several compelling advantages, especially for those just starting their investment journey. It simplifies the process and builds good habits. Let's explore some of these benefits in detail. One of the primary benefits of DCA is its ability to mitigate risk. By spreading your purchases over time, you reduce the impact of any single market fluctuation. You're not putting all your money in at one potentially high point. This strategy helps protect you from making a large investment just before a market downturn. It smooths out the entry points, making your overall investment less susceptible to short-term volatility. Investing can be an emotional roller coaster. Fear and greed often drive irrational decisions, leading investors to buy at peaks and sell at troughs. DCA provides a structured approach that bypasses these emotional traps. By automating your investments, you take the emotion out of the equation. You simply stick to your predetermined schedule, regardless of how the market is performing on any given day. This fosters discipline and patience. As mentioned, DCA naturally averages your cost per share. When prices are low, your fixed investment buys more shares, effectively lowering your average cost. When prices are high, you buy fewer shares, preventing you from overpaying significantly. This averaging effect is crucial for long-term growth. It ensures that you are consistently participating in the market, accumulating assets over time at a more favorable average price than if you tried to time your entries. Consistency is key to successful investing. DCA instills this discipline by requiring regular, scheduled contributions. This habit of consistent saving and investing is invaluable for building long-term wealth. It encourages you to prioritize your financial future by making investing a routine part of your budget. This disciplined approach helps you stay on track towards your financial goals, even when market conditions are challenging. You don't need a large lump sum to start investing with DCA. You can begin with relatively small, manageable amounts, such as $50 or $100 per month. This makes investing accessible to almost everyone. This accessibility is particularly beneficial for beginners who might not have significant capital to deploy upfront. It allows you to start building your portfolio gradually and comfortably. Let's consider a hypothetical scenario. Imagine you decide to invest $100 every month into a particular fund. In month 1, the fund's share price is $10, so your $100 buys 10 shares. In month 2, the price drops to $8, and your $100 now buys 12.5 shares. In month 3, the price rises to $12, and your $100 buys approximately 8.33 shares. After 3 months, you've invested $300 and acquired 30.83 shares. Your average purchase price per share is approximately $9.73, $300 divided by 30.83 shares. Notice how this is lower than the average market price of $10, $10 plus $8 plus $12 divided by 3. This example illustrates how DCA helps you acquire more shares when prices are lower, effectively reducing your average cost over time. It demonstrates the power of consistent investing through market fluctuations. While DCA is a fantastic strategy, it's important to understand its limitations. It's not a magic bullet and might not always outperform other strategies in every market condition. In a consistently rising bull market, a lump sum investment made at the beginning might outperform DCA. This is because the lump sum would have been fully invested earlier, benefiting from the continuous upward trend. However, predicting a continuous bull market is impossible. DCA is designed for the reality of fluctuating markets, where timing the absolute bottom is unrealistic. It's a strategy for long-term average performance, not short-term maximization. DCA also does not guarantee profits or protect against losses in a prolonged bear market. If the market continues to decline for an extended period, your investments will still show losses, even with DCA. Its benefit is in averaging your entry points. To effectively implement dollar-cost averaging, consider these practical steps. They will help you integrate this strategy seamlessly into your financial plan. The easiest way to stick to DCA is to automate your contributions. Set up an automatic transfer from your bank account to your investment account on a specific date each month. This ensures consistency and removes the temptation to skip investments. Automation removes the need for conscious decision-making each time, reinforcing the disciplined approach. It makes investing a regular, effortless part of your financial routine. Decide on a regular interval that works for you, whether it's weekly, bi-weekly, or monthly. The key is consistency. Sticking to a schedule helps you maintain the averaging effect over time. A monthly schedule is often convenient for most people, aligning with typical pay cycles. The exact frequency is less important than the commitment to regularity. DCA works well with diversified investments that track broad market performance. Index funds, exchange-traded funds or ETFs, and mutual funds are excellent choices for beginners. These vehicles offer diversification and generally lower fees. Avoid trying to DCA into highly volatile individual stocks unless you have a deep understanding of the company. For beginners, broad market exposure is usually the safest and most effective approach. While DCA is a long-term strategy, it's still wise to review your portfolio periodically. This doesn't mean reacting to daily market swings, but rather checking if your investments still align with your financial goals and risk tolerance. Perhaps once a year, assess your asset allocation and make adjustments if necessary. This ensures your DCA strategy remains aligned with your evolving financial situation. Dollar-cost averaging is a cornerstone strategy for beginner investors. It simplifies investing, reduces risk, and builds crucial financial discipline. By consistently investing a fixed amount over time, you can navigate market volatility with greater confidence. Remember, successful investing is often about time in the market, not timing the market. Embrace the power of consistency, and let dollar-cost averaging be your guide to building a strong financial future. Thank you for joining us today.